But the goal here at AOA is to help you be successful, and that's really the bottom line goal. So we're always looking for um, different resources that we can present to you that'll give you ideas on how to either make or keep more money through your investment real estate, maximize that investment, and get you to a place where you can retire early and be financially independent and leave a legacy for your kids. And so we all have those similar goals. And what you find, so many of you are already members. This is a group of learners. It's a learning community. So we're reading the magazine, we're looking at the live streams, and just continually growing and getting other resources. And if you need closed caption, the Facebook, I believe it's up. Sometimes we have some difficulties, and that'll be closed caption live if we have that working, hopefully. And if you are on YouTube, so you could go to Facebook, or if you wait until after the presentation, then YouTube does turn everything, does put a caption on it. And you may have missed it, but Dennis Block, eviction attorney, spoke regarding the LA County and the LA City moratorium extensions, and there's a whole lot there that you need to know if you have property in LA County or LA City. And so definitely catch that one. Just search AOA USA and you'll find that one right away. Search AOA USA on YouTube and you'll find that one right away. And also we had one about SB 9 or the upzoning last week. Definitely great stuff from Mr. ADU. You'll want to watch that. And a couple weeks before that, we had one on how to protect your property. And so definitely that's another one. Even if whether you're selling or not, you want to watch that and see how you can increase the value of your property and increase the happiness of your tenants, and also decrease your headaches, because you're going to avoid some of the bad tenants by taking care of your property. And so all these things are just ways. We have one coming up on mold remediation. We have one coming up on storage units. So definitely subscribe to the newsletter. It's a free e-newsletter that we send out. Send out updates if there's things going on in your area. And you can sign up for that by going to the AOAUSA.com website. That's AOAUSA.com. If you go there, scroll all the way down, you'll see a place where you can sign up for the newsletter. So definitely do that. If you're like, I don't get any of these and I already am a member, well, update your email address with us, and then you'll be getting them. And also look in your spam, because there's quite a few people that have said, hey, I'm not getting them, and what they find out is that it's sitting in the spam. So check your spam folder. This event is sponsored by K Properties. They are national DST, so they're licensed in all 50 states. So even if you're watching from Hawaii, they can help you. And they have a tremendous amount of flexibility. They have over 115 years of experience collectively. They've done 15 billion of DST 1031 investments over the years, and they have access to over 25 different sponsor companies. And so they are looking at everything and not pegging it to just a few, but looking at everything. And so our speaker today, he is headquartered in Los Angeles, and I know that they have offices all over the place. So just it doesn't matter where you're at in the state. And his specialty is a 1031 exchange and direct investments, and he'll tell you more about himself, all of his credentials. And so it's my pleasure to introduce to you today, Matt McFarland.
Thank you, Jeff, so much for the introduction, and I really appreciate everyone tuning in to learn a little bit more about some of the tax saving strategies within the 1031 exchange. I am sitting here in our corporate offices in Torrance, in the south part of Los Angeles, and I'm very excited to dig into some of the reasons to sell the income property that you love. As Jeff mentioned, my name is Matt McFarland. I am a vice president here. I'm based out of our headquarters in Torrance. And I've had the privilege of working with hundreds and hundreds of investors, specifically in the realm of 1031 exchanges, out of properties that they've owned for many years and into more of a passive investment vehicle. So we're going to spend some time going through that this morning. We are going to have some time at the end for Q&A. So I'm looking forward to answering some direct questions as well. So once again, topic for today is going over 3 of the main reasons why you might considering selling an investment property that you love, and most importantly, how to avoid taxes, when you do it. So, a lot of investors might initially recoil at the thought of selling a piece of investment property. And, sometimes it can, not make sense if, the tax deferral strategies aren't there. The important thing about the real estate economy is that we've had the luxury of accessing an amazing tax deferral strategy through what's called the 1031 exchange. Many investors are surprised that the 1031 exchange has actually been around since 1921. It's been a part of the Internal Revenue Code for over 100 years. And I would say that over the last 10 years specifically, this country has experienced arguably the most expansive bull market in real estate history. So congratulations to all of you for being a part of that. And we are seeing properties, list and sell for record prices, especially in California. There is this notion of trapped equity in real estate, right? Values have gone up significantly, and the cash flow that investors are receiving doesn't quite match the growth that they have experienced in terms of the total value of their property. So what our firm does, and we're going to dig into this just a little bit more here, is look at ways that we can take advantage of the 1031 exchange, which allows property owners to defer taxes upon sale of investment real estate, and consider potentially, an alternative option, a more passive option that could afford investors the opportunity to dial back their active management and transition into a different stage of life. So we're going to go ahead and jump right into those 3 reasons. So reason number 1, and of course, this is arguably the most important, is the ability to use a 1031 exchange to defer taxes when you sell your property. So you could see here, this first bullet point, occasionally the tax code actually does make sense. And one of those occasions happens to be the 1031 exchange, which allows you to sell a property at a hefty profit, especially in today's economy, and defer the taxes when you move your money into a like-kind property. Like-kind is one of the definitions that a lot of investors get confused on. So like-kind does not refer to the type of property that an investor has to reinvest into, but rather the character or nature of the property itself being categorized as an investment property. So this definition is actually much more expansive than people typically, give it credit to. And what our firm specializes in specifically is the Delaware Statutory Trust 1031 exchange. And these are a way for investors to move tax deferred capital into these larger group ownership investment vehicles that are professionally managed for them. So number 1, taking advantage of the 1031 exchange. Reason number 2, you are sick and tired of having to actively manage your real estate. I have the luxury in my job to interact with real estate investors all across the country, dozens and dozens of different clients and potential clients. And it's really amazing the stories that I've heard over the years doing this of the incredible demands of managing real estate. I think especially here in California, where it's very, very difficult to manage real estate, to interact with tenants with any type of freedom. There's onerous rent control, regulation, and other aspects that could impact the business of being in the business of owning and managing real estate. And really, this is a 24-hour a day, 7-day a week commitment, right? A tenant can text you, call you, email, at any hour. And, sometimes there are emergencies that have to be responded to, very quickly. So while dealing with the tenants, many investors come to a stage in their life where they are sick and tired of the tenants' toilets and trash, the terrible T's, as many of you are familiar with. And they're able to move away from the terrible T's, the toilets, tenants, and trash, defer the taxes while doing so, and continue their investment in income producing real estate, investment real estate, but only take a slightly different approach. And that approach is the Delaware statutory trust structure. And they can do this through eliminating all of the hassles and costs that come with management. So investing fractionally into a carefully selected portfolio of these income producing, investment real estate offerings, you don't actually have to manage anymore. There's another company that's going to be managing your investments for you. They're going to be the ones responding to the calls on Christmas Eve as you're sitting down for Thanksgiving dinner. And you get to take more of a back seat towards investing in real estate. And this could work really well for many of our clients who are looking for a lifestyle change. You want to spend more time on the golf course. You want to spend more time with friends, family, maybe even other business ventures that could be more profitable for you in this stage of life. There's a lot of different reasons why this could be attractive for investors. Of course, this certainly isn't for everyone too, right? We recognize that. If you are the type that enjoys being very, very involved, these probably aren't for you, right? This is a passive turnkey strategy specifically for investors who want to defer the taxes and move away from active management, and also diversify while doing so. So reason number 3 here is you get the opportunity to invest in larger real estate deals. So this is a very key difference, in my view, from a traditional 1031 exchange, where you may sell a single family home somewhere in Los Angeles and buy another single family home in another market in Los Angeles. Or maybe you sell a single family home in West LA, and you exchange for 3 single family homes in Texas, right? We see a lot of investors, actually moving out of California into more business friendly environments. So one of the key differences with the Delaware statutory trust properties is that these are typically going to be institutional sized and caliber real estate offerings that are made accessible to high net worth, private accredited investors through this unique trust structure. So the Delaware statutory trust structure. So in this middle chunk of text here, you can see a couple of examples. So this could be anything from a $20 million apartment community, $5 million pharmacies, $15 million grocery stores. On occasion, there's even portfolios of properties that are owned by a single DST that can be valued upwards of $100 million plus. So these are larger, typically institutional grade real estate opportunities that are now made accessible to an investor at a smaller price point because they're able to buy in and own a fractional interest or an undivided interest in the trust that holds deed or holds title to the actual real estate. And there's some advantages with that, certainly, right? The institutions, they typically play on a different playing field, right? Many of the companies that we work with, they're preferred borrowers with, Fannie Mae, Freddie Mac, right? They have access to pricing when it comes to debt that you or I would never have access to, right? They have a network of brokers and preferred different relationships across the industry because they're constantly in the market, right? These companies have floors of acquisitions, people that are constantly looking for deals across the country. So they're going to be shown, properties that you or I would never, have access to. So the DST is really unique in that it gives investors the ability to participate on the institutional kind of side of this real estate investing, but without any of the active energy that is required to source and close on a deal, to continue to manage, to compile all the tax information at the end of every year, to actually list and sell the property. That's all going to be done by these large third-party institutions. And on top of this, one thing that I wanted to point out too is that these properties, these DST investments, they typically have very low minimums. So the minimums can be as low as about $100,000. Most of the clients that we work with, in specifically in Southern California, Northern California, the typical exchange can be anywhere from, $500,000 to $5 million is typically the range. And so with the minimums being as low as they are, diversification is incredibly accessible for most of our investors. So with the DST, the ability to diversify is another unique characteristic that most investors would not have the ability to do if it weren't for the fractional ownership nature of the DSTs. And this is where K Properties, comes in, is, we have access to the greater marketplace of DSTs. We can help work with you and other, accredited investors to actually come up with a portfolio solution that could work for your situation. Many of our investors will actually, they'll invest in several different DSTs with different DST companies in different markets across the country, different asset classes too, different property types, are kind of designed and built to accomplish different things. One thing I wanted to mention, in all fairness, is that DST properties, much like real estate, come with risks, right? Every investment, no matter how conservative that investment is structured, comes with a certain degree of risk. And so what we're trying to do at K Properties is to eliminate as much risk as possible, right? And we're never going to eliminate all the risk, right? There's always going to be bad with the good. And if we have the opportunity to work together, that's one of the large kind of segments of time that we spend with our clients, is actually going over all the individual opportunities and identifying the pros, but also with the cons, right? We want our investors to go in eyes wide open, knowing exactly what they're getting involved with, making the best decision they could possibly make given, what's available and what they're trying to accomplish in the short, medium, and long term. And so one thing we can't control is your general real estate risk, right? The market can turn, right? We've been in a growing, expansive bull market for the last, 10 plus years. It's likely not going to continue that way, right? We're due for some type of correction. No one knows exactly when that's going to come. We're starting to see interest rates, go up. That could certainly create a general softening in the market. I mean, no one has a crystal ball. No one knows exactly what the future holds. But what we can know and what we can control is encouraging our investors to diversify, taking away some of the concentration risks should something happen on one given DST investment that they participate in, right? So what we're trying to do is use diversification as a way to hedge risk, right? We don't want to try to pick the winning horse, using a horse racing analogy here. We're trying to pick, 5 horses out of the 40 horses that are racing that have, the highest likelihood of placing somewhere close to the finish, right? So this is a completely different approach towards your kind of traditional real estate investing, and almost like taking more of a mutual fund like approach towards tax advantaged real estate deals that are set up as Delaware statutory trust investments. Another thing I wanted to mention with respect to kind of mitigating risks or hedging risks, comes with controlling the amount of debt that we take on in the process of a 1031 exchange. So many of you are aware that when you do a 1031 exchange, you must purchase equal or greater total value from what you sold. So if you own a property that you've held for 40 years, let's just say, somewhere in Southern California, you've completely paid off all of the mortgage. You own it free and clear. If you go to sell that property, as part of the 1031 exchange, you actually don't have to replace any debt, right? You don't have to go to a bank as part of the process of reinvesting and get a new mortgage to buy a different property, right? You can buy the next property free and clear. And so in the DST structure, we have access to DST investments that are owned free and clear. And that is one of the controllables that we're able to include into an investor's portfolio that is in that situation, right? A lot of our investors, they're at a stage of life where they're looking for preservation of capital, right? This is a preservation of capital play. This is not a wealth accumulation strategy. So with that, one of the ways that we can attempt to preserve principal in a real estate investment is by eliminating the risk of lender foreclosure. And how we do that is by taking debt completely out of the equation. And so that's another kind of hedge element to eliminating some potential risk, right? There's always going to be risk of foreclosure if there's any ounce of debt on a real estate property. Yeah, if you have moderate debt, modest financing, it could be very unlikely, but it's still a possibility. And on top of that, there's certain property types too that tend to interact and behave a little bit more friendly with certain debt structures, which is, something we go over through, our educational process. One other thing I wanted to mention with that is there are investors that do need to take on debt as part of their 1031 exchange. And so there are DSTs that come with prearranged financing that allow investors to replace debt very seamlessly within a DST. So we have access to DSTs that are leveraged. There's certain investors that may want to take on some potential tax advantages through leveraging their equity in a real estate investment. We always are sure that they are engaging with their CPA and tax attorney along the way. But that is another potential option for them. The last thing kind of I wanted to mention here, as we start to move to close, in today's market, we are in a seller's market, right? I was reading a statistic yesterday, and I think it was, don't hold me to this exactly, but the average home price in this country has gone up somewhere between like 15 to 17% year over year. We typically, in these conservatively structured real estate deals, we're not anticipating that degree of growth, right? So the growth that we've seen over the last 3 years specifically has been enormous. And in this seller's market, properties are listing and selling at record rates. It can be very, very difficult for a 1031 exchange investor to sell their property and exchange into another property successfully that they buy on their own. So more kind of a traditional exchange. Not only is the environment extremely competitive, but when we're talking about a traditional exchange, there is a lot of due diligence that goes into making sure that this is a property that the investor would like to purchase into. There is a lot of back and forth, with the seller, especially if there's other offers on the property. Can be very difficult if you get into a bidding war with other potential investors. And so DSTs actually help eliminate a lot of that closing risk. These properties are all prepackaged, they're owned by the trust prior to being offered to the investors. So as long as the equity is available, if the offering is still open, investors are able to exchange in very seamlessly. We're talking about a 3 to 5 day close, 3 to 5 business day close from the time that the investor fills out the subscription documents to actually subscribe to a given investment. And that actually is another way that we can hedge risk in some way, if you think about it, as the certainty of close. If we can increase that, we have a lesser chance of being in a situation where an investor has a failed exchange if they're not able to close past the 45-day window. So there's a lot of really kind of unique advantages that the DST offers that is, I think worth discussing and being aware of. And it's our firm's approach, and many of you have seen us, over the last handful of years. We've been a great partner. We've been partnered with the AOA for many years here and have engaged in formats like this. But our approach is educational, right? So we want to provide all of the education. We want our investors to really have that foundation of understanding, so that when they do decide to sell, if they do decide to sell, they have more certainty in terms of the direction that they're headed. And DSTs can be a very flexible option for investors. And we really appreciate, all the time that you have spent with me, even on this webinar today. But also, if any of you have engaged with us in the past, we really, really appreciate your time. And with that, I think I'm running out of time. So I'm going to go ahead and turn it back to Jeff. And I think we're going to jump into some Q&A here.
All right. And then if you stop sharing your screen too, then we'll be able to see your beautiful face a little bit more up close in person. There we go. Thank you, Matt, so much. All right, everybody. I told you it would be great, and he was for sure. And there's already some good questions there. I did want to mention that if you're watching this video on the AOAUSA.com website, in the bottom right corner, there's a blue help button. If you click on that, you can type your question in, and that question will get to be funneled to me along with all the YouTube and the Facebook questions. And so go ahead and type those questions in. Just as I give some announcements, some of you may have hopped on late, but just wanted to let you know about everything here. Let me see. Yeah, so you may have missed some of our other live streams. This may be the first time that you're on. We had Dennis Block speak. If you're LA County, that's a must see. Whether it's LA City or LA County, that's a must see. We had one on how to protect your property. And Matt, you'll love this. This guy, he did 12 years in a maximum security prison. Wow. And then he came out and did 10 years of property management. And so he talked about how to protect your property. Literally, he's called the shot caller. And because he used to say, get rid of him, get rid of him, get rid of him. And he used to be a tax collector, so to speak, and now from the jail. And now he's a, just totally different person. And he came on and showed us how to make your properties safe and how to deter bad people from entering. So that was really cool. But anyway, I'm going a little off on that one too much, but we have more stuff coming up. You don't want to miss it. Just about every week we have something. And so tune in next week. We have one on, in the future, we have one on mold remediation that you'll want to do. And let's see, upzoning was another one that we did just recently. So you'll want to see all of those. Oh, storage units, and how that's another way that you could, another way to have income. So we have all of that. So yeah, we'll get into the questions now. And let's see, we have Norman. I have a commercial property for sale. Can I buy a residential income property with my proceeds on an exchange? So he typed that question in right as you started. He probably has the answer, but we'll let him just in case he fell asleep.
So the answer, Norman, is absolutely yes, as long as the residential property that you're purchasing is not used as your primary residence. It needs to be used as an investment, a piece of real estate. And if it can be used as such, then absolutely yes.
All right, Jonathan David. Do you have a good referral for a CPA that works with exchanges? And I would say that most CPAs would. And if you go to the AOAUSA.com website, there's a contractors and vendors page. If you go there, you can look that up. And we do have a live stream that was done by Robert Hall and Associates with Tony Watson. If you're in the Southern California area, they would be a good reference. But there's several that will be able. It's something that it's very common, and a lot of people are utilizing this strategy. Okay, Venice Bazaar. What do you recommend? 1031 exchanges in a market where there are so few properties for sale, i.e. it's scary to trade up when you're not sure if there will be anything you want by the time you sell. So great point. I'll let you hit it, but I'll let you address that one.
Definitely. Yeah. And this is the exact issue that most people have when deciding whether or not to exchange, especially now. And so many people can get such great value for the real estate. But the question is, if I sell, where do I go? And it's a very, very valid concern. And people really struggle with this in a more traditional sense, especially, being in a seller's market. With the 1031 exchange, you buy back into the same market that you sell into, right? So if you sell high, you got to buy high. That's just the way it works. And the IRS has created it that way for that exact reason, right? They want the economy to continue forward. They don't want people to try to time different real estate cycles and things like that. With the DSTs, it's a little bit different. The DSTs are pre-packaged. So actually, all the companies that we work with, they've actually gone ahead and done the due diligence. They've fronted the capital to close and acquire these different real estate deals. And then they'll work with, K Properties to effectively engage with potential investors who are looking specifically to invest in DSTs. So with the DSTs, we'll typically have 30 to 40 different DST opportunities on our platform at any given time. So we're very grateful to never have that issue where there's nothing to exchange into. To be fair, the DST, it's real estate, right? The only difference is it's a structured real estate deal that is eligible for a 1031 exchange. So with that, the DSTs are right in alignment with the supply and demand narrative that we're seeing in the general market today. So the DSTs, we may have 30 to 40 different DSTs. Maybe instead of selling out in 3 weeks, or I'm sorry, 3 months, maybe they're selling out in 3 weeks in today's market. And there's a lot of ways that we can work with that too. And it really is about engaging with K Properties if you are looking at DSTs early, so that we can actually take a look at what the available inventory is, even leading up to the exchange. So the DSTs, kind of like I mentioned at the end, are flexible in that. I think a lot of investors really like that, especially in a tight market like we're in today.
All right, G Chin on YouTube. Can I use a 1031 to buy out my sister's half of our father's house? The house is now a rental.
That is a really great question. It would depend on the way everything's structured. I am not a CPA or a tax attorney, so I am going to default to saying you'd want to reach out to your CPA or tax attorney to make sure that qualifies.
All right. Are return rates on DST comparable to multifamily returns in California, e.g. 10%?
Mm-hmm. Yeah, so it's a really great question. And I think what we've experienced over the years is that California real estate does really well when it comes to appreciation, right? There's a lot of equity in California real estate. We're very blessed in that sense, over and above, most other markets across the country. Where California struggles typically is in the cash flow department, right? So when our clients are doing a cash flow analysis on their rental properties in California, and they take away all the expenses, and look at that true net operating income compared to the current value of their property today in today's market, typically the cash flow is pretty low, right? And that's just because real estate is so valuable here compared to other markets. So if we're talking about, return, there's really two different aspects we have to consider, right? There's the cash flow and there's the appreciation. Cash flow can be a little bit easier to predict, right? You can look at your current occupancy, you can look at, different expense ratios, you can look at, demographic, trends in the area. However, it's, still a projection. So, we don't know 100% that a given investment will perform to a certain cash flow degree. What's more difficult to predict is appreciation, right? So, I'd say typically, one of the benefits of real estate, especially over the last 10 years, is that real estate's gone up a lot in value. I would say that no one would have foreseen the value increase that we've seen over the last, 3 years, especially maybe 3 to 5 years. So when we're talking about total returns, it can be difficult to say exactly what the future is going to hold. And I would say for us, we're looking to primarily protect investor principal. So that's going to be number one. Cash flow, predictable, durable income. That's usually kind of the second category that we're looking at. And I would say most of the investments that we offer are going to be somewhere in the 4 to 5.5% range from a cash flow perspective. Of course, it's, not guaranteed, and it's just a projection. And then the investor, the unique thing with the DST is the investor actually gets to share in their pro rata portion of the net proceeds when the DST sells. So that could very much be a part of the business plan, and is part of the business plan with many of these, is to hopefully sell the real estate for more money than it was purchased for today. And that's where I think it's really important too, understanding where we're at in the cycle and being really selective and being wise about how we're allocating the money to different types of properties, different areas, because there's, a lot of things have changed and will continue to change. So hopefully that kind of answers the question there. But I'd say, yeah, most of our California investors can actually potentially increase their cash flow by exchanging out of state. The appreciation, it's just difficult to compare to California. So not always, sometimes, it just depends.
All right, Kurt, I've heard that you require 1 million net worth excluding the real estate. Is that true?
So the accredited investor definition is describing an individual who has a net worth of 1 million or more, not including their primary residence. To take away your home, the value of your home, all of your other assets minus your liabilities has to equal or exceed $1 million. If that's the case, then you qualify. If it's not, then you would not meet that definition. So it's retracting the primary residence from the equation.
All right, Tony, can I sell a business and buy a different business under 1031 rules?
So the 1031 exchange is restricted to real estate. So the answer is no for that one. If your business happens to come with a real estate element, we see this frequently with small business sales. Maybe the owner also owns the real estate that they operate out of. That portion can typically be utilized in a 1031 exchange trade, but any type of non-real estate value is not a part of that exchange.
All right, here's May. Can I buy from a family member?
It's a good question. I've seen it done in the past. Once again, a lot of times when we're talking about tax deferral or anything to do with the tax code, a lot of the what investors need to be careful with, what everyone needs to be careful with, is intent, right? So once again, I would defer that in a 1031 exchange sense to your CPA or tax attorney to make sure that would stand up, any future audit risk in the future, because typically if there is an audit, the IRS is going to point to intent. And I just don't know exactly how that fits in with the 1031 exchange.
And I think we have Robert Hall. They're going to be speaking in the next few weeks, I believe. So that's a great question to ask. They prepare taxes, so they'll be a great person to ask that question. Please talk about the exit. Do we gain equity? What if we die? Can we pass it on to nieces and nephews?
Mm-hmm. Yeah, so the typical exit of a DST comes between 5 to 10 years. So each of these DSTs has a specific business plan where these companies will target a certain window of time to exit the property. And when I say exit, I mean they sell the entire property that the investors all collectively own, right, through the DST. So to answer that first question, if the property sells for more than it was purchased for after the closing costs associated with selling, then yes, the investors would share in their portion of the upside in value. If it sells for less, then the investors would come out with less than proportionately to what they invested in. We've been fortunate where many of these properties have done very well. So a majority of the time in our experience, it's been yes. But once again, it just varies, based on the real estate, and past performance has no indication of future returns as well. In terms of the step up in basis or passing away, the DSTs are treated identically to any other type of investment real estate. So a step up in basis, would be realized upon death, and pursuant to the will and trust of that investor. The ownership in the DST would be reassigned to family members, nieces, nephews, daughters, sons, however that investor's trust is set up. And the nice thing with the 1031 exchange is it essentially allows the investors to defer the taxes continually across the entirety of their lifetime, and then pass that real estate along to their heirs with a new basis, right? And that's a big part of the estate planning strategy of all this too. Jeff, did I miss? Was there another question there that I missed, or?
No, I think that does it. And also, just to say, with in California, we're Howard Jarvis Taxpayers Association has an initiative to repeal the death tax. We need 1.5 million signatures on that. Definitely check out their website, and we are fully supportive of that. And in any of our offices, you can walk in and sign that, or you can drop off petitions if you're circulating them. So anyway, just want to mention that, since we're touching on that a little bit, because that was one that kind of tricked a lot of people. There was some real tricky, sneaky advertising. And so, yeah, here we are. And Nick, is there any way to avoid having to replace an existing loan with equal or greater loan amount?
There's kind of two options. So one is, replace the loan amount with new money. So you can use the cash that's generated from the sale, and you can pull fresh capital out of your pocket and buy something of equal or greater value. And that should qualify for a full deferral in taxes. Or technically speaking, an investor can do a partial 1031 exchange, can buy something all cash, not take any more debt. However, the shortfall, or the difference, which in this case would be the loan amount, would be a tax liability. So it'd be a partial 1031 exchange.
All right. I think this is similar. If I sell my property, can partial amount go into DST and the remainder into a new property?
Absolutely.
Oh, yeah. Yeah, that works. Yeah.
Mm-hmm.
Yeah. So if you can find it, and then just there's that window. So tell them about the window, I guess.
Mm-hmm. Yeah. So there's the 45-day identification window. And I'm really glad this question was asked too, because I didn't touch on it in the presentation. Yeah. But the DST is a much more flexible acquisition than a traditional real estate purchase, right? So DSTs can be used in an array of different approaches. So the first is in a primary sense, right? So this is take 100% of your proceeds and you just buy all DSTs, right? It's your primary approach. The second would be directly answering this question, where it's used to cover the difference in an exchange. So someone sells for $1 million, they find the perfect replacement for $850. They can take the 150 delta and they can invest that into DST and still achieve a full tax deferred status, right, through a 1031 exchange. The last option, which I think is relevant in today's market as well, and in any market, is using DSTs as a backup ID. So if you have no intention of buying a DST, if you want to go out and buy another property that you self-manage, even having the DST in your back pocket as a backup tool, where maybe you list a DST or two on that identification sheet with a qualified intermediary, could potentially hedge, some of your closing risk in the 1031 exchange. I'd say, from my own personal experience, we have investors that from time to time do use DSTs in a backup sense. And you'd be surprised how many people actually end up, coming back and needing the DSTs because something unforeseen came up with their initial close. So we're happy to be used in any sense, in any way that we can and offer value. But those three are kind of very different but unique approaches that the DSTs can be used for.
Murphy's Law comes to mind.
Right.
So have a backup and then you won't need it.
Yeah.
But if you don't have it, then you're really in trouble. And you might end up with a property that is, a real money pit, so there's definitely a risk on that one. Okay. Does Cape Properties do 1031 coordination start to finish? Are you a broker as well?
So we are a broker for DSTs specifically. So think of us as a buyer's agent. Instead of helping you find real property, we help you find DSTs. So that's the best way to explain it. We actually never touch your money. So the money goes from, escrow on the sale to the qualified intermediary, from the qualified intermediary to the new properties. So in a sense, we don't handle every aspect of the money transfer, but what we can handle is every aspect of the upleg part of the exchange, right? We're not going to help you sell your property. We're not going to help you buy properties that you self-manage and own by your own, on your own, but we can help you with the purchase of the DSTs in a brokerage and advisory capacity.
Great. Yeah. So if you're in the LA area, get a free valuation of your property. Our guys put a lot of time into that for you. That's free. And so, yeah, if you are thinking of selling, you could do that. And we got guys that'll help. They've been around for years and years. Okay, let's see. In the chat is Art. If I have to sell DST early, what is the penalty or consequences? From your experience, what is the worst loss on investment that you've seen personally?
Mm-hmm. Yeah. So starting with the first question, with selling early. So the DST, it's a private real estate security. So technically speaking, interest can be bought and sold at any point in a DST. That being said, we always advise people going into DSTs, you should have no intention of selling early and straying away from the business plan, which is realized when the entire property is sold, right? So in other words, this is an illiquid security, don't plan to sell. If there is a situation, and situations happen where there's an unforeseen medical expense, an emergency, and an investor needs to get out, they can. And we can help them essentially list their interest on our pseudo secondary market, which is just us shopping the interest around our current investors and other potential investors. And really at that point, it's a negotiation between parties. So the same aspects of any real estate trade would be at play here. So circumstances behind the sale. If you need the money tomorrow, you're going to be willing to part with it for less or sell for less than if you had no time kind of crunch, right? How the property is performing. The property is doing really well, then you're probably going to get more money for it than if the property is really struggling. So there's different aspects that are related to that. And we can walk investors through that certainly and do when these situations come up. I would say it's pretty rare that these early sales take place. We probably do 5 to 10 of these a year, and we do thousands of transactions in a primary sense into DSTs. So they are few and far between. It's possible, not advisable. It's the best way to put it. The second part of the question, in terms of my experience with DSTs that have not done well or have overperformed or underperformed rather, we have had an example of one DST that one of our investors was a part of that was foreclosed on. So in that sense, that investor, they lost the entire principal amount of their investment. To put it into perspective, once again, past performance does not indicate future return, but we've been a part of about 3,400 different DSTs. And we've had one DST that has, to my knowledge at least, that has underperformed in the greatest sense. There's been several others that have sold for a little bit less than what they were put together for, a majority of them have all sold, for a profit. And this is the perfect question too, and something that we go over on an individual basis with all of our investors, prior to even making the decision to invest in DSTs, is really understanding, look, you can lose everything investing in real estate. You can lose everything investing in DSTs. It's no different. So let's be aware of the risk factors, before we go in, and have everything out there in the open.
All right. So selling on that, where they lose 10% on the ones where they actually got out early, they lose, what was the most they lost?
I've seen, yeah, it's hard to say a range, but I would say, usually,
worst one. Yeah. Forget the range. Worst one that you can remember.
The worst one on the secondary that I'm aware of, I think they sold for 20% less than what they bought for.
So 80 cents on the dollar.
Mm-hmm.
Basically. All right. There you go. There's your answer. And yes. Can you exit early before end of DST terms? Yes. Christina, can you pull out of DST to buy real estate property in the future? Yes, right? They can go and roll that into another 1031 where they're actively managing it. So if you just have a baby and you want to focus on the baby and not deal, then boom, put it in for 5-10 years, you get that back, and then you can start going full time on all your properties again, right?
Right. Yep. The whole process repeats itself. So if the investor decides to go back into real property, management and ownership, they 100% have the flexibility to do that.
All right. Jack on YouTube, is there a limit on how many DSTs you can list on your 1031 property identification?
There is a limit, and the limit comes down to the identification rule that's used. So most DST investors use what's called the 200% rule. So that means that you can list an unlimited number of physical addresses or properties, but you're limited to 200% of the relinquished property's value. So that depends on the size of the transaction. Of course, we talked about the typical minimums in a DST. So it depends on the investor situation, but you're going to be limited based off of what identification rule you select, and based on different circumstances, different rules are utilized, but typically the 200% rule is what investors use.
All right. What's the average life of a DST? You already said 5 to 10 years. Mm-hmm. JV rebroker, what's the approximate associated costs of setting up a DST?
So all the costs in a DST is already factored into the price that it's being offered to investors for. So there is some premium built into that price, but it's all inclusive, right? So this is a turnkey, investment vehicle. The costs vary based on the different DST company. Everything's fully disclosed. Like, we operate in a very tightly regulated industry. And so every single offering has what's called a private placement memorandum. And in this private placement memorandum, there's a page that clearly item by item lists out every single fee and expense that is related to that particular offering. Once again, this is something that we review in detail with all of our investors, prior to them deciding to invest. But certainly there is some premium cost built into a DST because you're paying someone else to do the management for you.
Yeah. Another way to ask the question, what's your cut as K Properties?
Yeah. So we earn the equivalent of a real estate commission, right? I mentioned, think of us as like a buyer's agent or buyer's broker for DST specifically. So we're compensated transactionally. We're paid by the seller, which is the DST company that's putting it together. Our cost is built into that premium cost that is packaged in the DST. Typically 2 to 3% on total purchase. Sometimes it can be a little bit more, sometimes a little bit less, depending on the deal, but very similar to a traditional, real estate purchase in that sense.
Great. Well, thank you so much, Matt. You always have great answers for us and explain things in a way that everybody can understand. So we appreciate that. And like you said, we have been you've been advertising with us for years, and have just been. We haven't really gotten many. I'm not sure if we've gotten complaints on you. So you can look at your Google reviews. I'm sure they're real high. And anyway, so thank you so much for sharing. Any parting words for us?
Yeah, I just say thanks again, Jeff and the AOA, for allowing us to present, and for everyone listening. We really appreciate you taking the time out. And I would just encourage you. We have a great website with a ton of really great educational information, of content that we've produced, for well over a decade. So would direct everyone, back to the website. And if you're in touch with someone from our firm, whether it's me or anyone else, if there's any specific questions, we'd love to talk to you. Please, reach out to us anytime. But thanks again, and wish everyone a great rest of the day here.
Great. Thanks, Matt. Yeah. And so at the bottom of the YouTube, there's a more section. We'll have your information there, and it's definitely across the screen. I see it on the screen as well. So they can go ahead and write that down while you have a second. Remember, you can always go back and watch this again. If you go to YouTube, type in AOA USA, and all of our content will all come up. You'll be able to see stuff. You can binge watch. Talked to a new member last week that was binge watching stuff. And so definitely go back and look at some of the things here that'll be relevant to you. And I just love how everybody's a learner. Everyone in the association, if you can't join without being a learner. So it's really neat to interact with everybody. And we'll see you next week. And again, in 2 weeks, we'll have one on storage units. And then I think maybe the week after that is going to be the tax, the one on taxes. And then we'll have one on mold restoration. So there's lots of content that's coming down the pipe that's not even listed. And so anyway, hope to see you there. And we'll see you next week. Thank you, everyone. All right. Well, thank you so much, Matt.